My name is Laurie Dean. I'm doing my health insurance sales presentation for Elizabethtown College. For this presentation, we will identify the small business that was selected. We'll look at the different health insurance plan options. And as an insurance broker, we will identify some of the best health insurance plan options and some of the worst health insurance plan options for this business. We will include information about each health insurance benefit in order to determine what would be the most affordable option for this employer. Small businesses rely heavily on brokers and insurance agents to facilitate the purchase of coverages and to interact with the insurers and providers regarding any coverage issues. The small business that was selected was a small roofing company. They have a total of 24 employees, 22 are full-time and 2 are part-time office employees. The business opened on August the 1st in 2009. They're currently offering health insurance, so they do qualify for the grandfather status. Companies with less than 50 full-time employees are not required by the Affordable Care Act to offer health insurance coverage, so they're not subject to the pay or play that's mandated by the ACA. Best health insurance policy options would be the SHOP Marketplace Exchange, health savings accounts, flexible savings accounts, consumer-directed health plans, or high-deductible health plans. The SHOP Marketplace Exchange is known as the Small Business Health Options Program. This is for small businesses with fewer than 50 full-time employees. Employers may qualify for tax credits. In order to qualify, employers must have less than 25 employees. They must pay at least 50% of the health insurance premiums for these employees, and their employees must make $50,000 or less on an average annually. The tax credit would be up to 50% of the premium cost that they are paying. The tax credit is based on an average premium cost where the employees are enrolled, regardless of whether the employer is paying higher premium costs in that particular area. This is an affordable option for employers if they have a higher claims experience to purchase coverage in a blended risk pool, keeping their premiums lower if they purchase insurance through this SHOP exchange. Savings accounts, also known as HSAs. In order to offer this benefit, an employer must offer a high deductible health plan. The two go hand in hand. Contributions can be made by the employer and the employee. These are tax-sheltered account contributions, and they're tax-free. They're not subject to federal income tax. Payroll deductions are pre-tax. Money can be used for qualifying medical expenses, such as co-pays, co-insurances, deductibles, doctor's visits, prescriptions, dental and vision care. The money from the health savings accounts cannot be used to cover premiums unless you're on COBRA or while you're on unemployment compensation. The nice thing about the HSAs is that unused funds can be carried over to additional years. They also can be transferred from one job to another or from one employer to another. They're an attractive benefit and they make businesses competitive with other companies, and they are also good for staff retention. Flexible savings accounts, FSAs. There's no health insurance plan required. The plan must be offered by an employer. There is a maximum amount that an employee can contribute, which is $2,500. This is a tax-sheltered account. The money may be used for qualified health care services, and the unused monies cannot be carried over from year to year, so it's a use it or lose it type of benefit. The consumer-directed health plans, also known as high-deductible health plans, these go hand in hand with the health savings accounts, or the HSAs. Most small companies look to offer these as a single health plan, such as a PPO plan, a preferred provider organization plan. They may include preventative services and a network of preferred providers. There are less out-of-pocket expenses when using the in-network providers than out-of-network providers. The worst health insurance policy options would be the self-insured plans with the stop-loss feature and the grandfathered status. Funded plans with stop-loss features. Here, the employer assumes the risk for the employee's health care benefits up to a predetermined amount. These plans include a stop-loss feature that is activated once the predetermined maximum is reached. At this time, the carrier assumes the risk and then becomes responsible for any additional health care claims for that year. The employer would pay all claim costs until that set threshold is met. Once the threshold is met, the stop-loss feature is activated and no additional claims are paid for that year. Roofing is a high-risk job, therefore this would not be a good insurance health plan option for this company to offer. Grandfathered status. In order for a company to be eligible for grandfather status, they have to offer a qualifying health plan and be open prior to March 23, 2010. They may add employees and may change insurance carriers. They cannot increase copays, coinsurances, deductibles, and other out-of-pocket expenses by much in order to retain this status. It's not the best cost-effective option for employers if they cannot increase other costs, as employer costs and premiums continue to increase. In conclusion, the best plans for this particular business would be the SHOP Exchange plan. With this plan, the company would receive tax credits, making this an affordable choice for the employer. One thing to note would be all requirements must be met, and the tax credit can only be taken for 2 years. Another option would be the high deductible health plan, such as a PPO plan, along with a health savings account. Switching to this plan, this business would no longer retain their grandfathered status. They would be able to offer a single plan that would have a higher deductible for their employees, but at the same time they could offer an HSA in which both the employer and the employee could contribute money. This would keep the premium cost down for the company, and both the employer and the employee would benefit from the tax-sheltered HSA contributions. By the employer contributing funds, this would help offset some of the out-of-pocket expenses the employees may have during the year. Because the roofing business is a high-risk pool and a competitive business, it is important to offer an attractive benefit package, specifically when it comes to employee retention. Here are the references that were used for this presentation. I'd like to thank you for your time, and I hope that you enjoyed the presentation.